Hey everybody, welcome back to Whiteboard Finance. My name is Marco and I'm here to help you master your money and build your wealth. In today's video, we're going to be talking about commercial real estate for beginners, so commercial real estate 101. We'll talk about different types of property classes. We'll talk about how to make a lot of money by forcing appreciation, aka equity, income, cash flow, different property types, class A, B, C, D, and then we'll talk about different metrics we use to measure these deals to make sure we're getting a good deal. So it's not going to be like a 2-hour long video or an hour and a half like I do with my stock market for beginners videos, but I will try to convey a lot of information in a nutshell just to get you started. So let's get right into it. So as always with my educational type videos, I always love to do them in a PowerPoint. If you don't like the PowerPoint format, this channel probably isn't for you. A lot of free game, a lot of free information in this video. Or you can choose to not watch my channel, wake up 20 years from now in the same financial position that you're in and kick yourself in the butt while looking at yourself in the mirror and saying, hey, I probably should have listened to Marco. Yeah, you should have. So here we go. So what is commercial real estate? So commercial real estate is property used for business-related activities or a 5+ unit living space. So anything in residential is considered 1 to 4 units, so single-family home up until a quad, at least with financing it is. And then 5 and above is now considered commercial. So what is the whole point of these properties? Why do people invest or build commercial real estate? Well, it's because it's leased to tenants for income generation. These are income-producing properties. So what are some quick types of commercial real estate? We have office space, which a lot of people have worked in at one point in their careers or lives. We have hotels and resorts. We have retail. We have multifamily. We have industrial. And we have mixed use. There's definitely more types, but those are the big ones. You have healthcare facilities. You have things like that. But I'm not going to go too much into the weeds here. I have a background. I worked many years in commercial leasing, commercial real estate development, analysis, and then also on the lending side of things. So instead of lending on single family homes, we would lend on, 30, 40, 50, $100 million projects, right? So I can give you some real life perspective here. So what is an office space? Most of you already know what this is. It's your typical class A, B, C, maybe D office space where people are conducting business, serious business. But everyone knows what office space is. What you may not be familiar with is industrial. So this is where you can think of like warehouses, production facilities, where semi-trucks pick stuff up, drop stuff off. There's a million different types of industrial. You have manufacturing. But that's typically, one of the bigger components of commercial real estate. Then we have multifamily. A lot of people are going to be familiar with multifamily. It's exactly what you think it is, typically apartments, things like that. So retail, here's what we have, an example of Acme. They're called an anchor tenant. So retail is typically, your strip malls, your shopping malls, any business to consumer component. Anchor tenant is basically a big anchor like a Home Depot or a Walmart or something like that. And then you have small auxiliary businesses all around it to fill up the rest of the property. So let's talk about some different classes of commercial real estate. I'm going to talk about A, B, and C. I'm not going to get into the war zone properties like D, E, F, things like that. We're going to stick to the A, B, and C. So with Class A, these are going to have your best aesthetics for amenities, and this applies to pretty much every aspect of commercial real estate. I'm going to be using office space for this example just because most people are familiar with it. So with Class A, again, these are going to be your best aesthetics or amenities. They're going to be newer construction. They're going to have high-quality infrastructure, and they're going to be in a great location. So think of a Class A like this. It's going to be like a skyscraper or a really nice building in a downtown location. It's going to have a lot of amenities. It's going to have a nice open lobby, things like that. So with Class B, you're going to be looking at typically older construction, smaller statues, so maybe a mid-rise, for example. Average common areas, maybe just, not even a security guard, but maybe just the lobby with some elevators, things like that. And then you're going to have average rents for the area, okay? These may or may not be located downtown. These may be in suburbs as well. So with Class C, these are going to be your lower or lowest rents available. They're going to have little to no amenities. They're going to have older construction. And then the location itself may be kind of close to industrial, maybe kind of off the beaten path. The location is probably going to be most likely an average to below average location. So think of Class A as this right here. Think of Class B over here. Think of Class C over here, where they just jam-pack you in a room and work you to death. No, I'm just kidding. So why do people invest in commercial? So I know this is a lot of words. I know you may get bored with this, but it's important, so pay attention. So portfolio diversification, number one. This is a hard asset backed by something tangible. It is real. It's not tied 100% to the market, even though commercial real estate typically lags the market or the economy by 1 to 2 years. And these properties can be unique. Not everything has to be, cookie cutter single family home. These properties can serve many different purposes. The next reason is because of cash flow and equity appreciation, ongoing rents or cash flow. More income means more equity, forcing appreciation. I'll give you examples. I'll give you math examples of this later in the video, so stay till the end. It can be passive. So we have syndications that you can be a partner of. The sponsor of this video is actually Fundrise. I'll be talking to them. Syndications can be powerful. You can be a limited partner. It gets you control of a high-quality asset with high-quality management, and you can actually be very passive through different types of leases, which we'll talk about soon here. This is a triple net lease. And then the last 2 points, we have long-term wealth building, and we have it being a recession hedge. So here's a quick story. I worked in commercial real estate for many years. Every single successful person that had a huge business exit, like hundreds of millions of dollars, they all have commercial real estate as part of their portfolio. The reason for that is because I'm telling you this. It's a long-term wealth builder. Commercial real estate is a long game. Most projects are over 2-year holds. Some can be 10. Some are generational, okay? This is when you have the lucky son that inherits his dad's portfolio, gives it to his kids, so on and so forth. That's how you build wealth in this country. So it allows you to ride economic waves, and it can also be a double-edged sword if you can't sell it. So commercial real estate is also illiquid. A recession hedge, so commercial real estate is less correlated with the market depending on the location and the tenants. So a McDonald's as a tenant is going to be very different than, a mortgage company flying by night like Boiler Room, just smiling and dialing. Interest rates go up. Now they don't have money for rent, right? So it just depends on the strength of the location and the tenants. So with the types of leases, so leases are usually quoted in dollars per square foot per year. Some places that are more expensive do it per month, but most of the country does it per year. So quick example, $25 a square foot for the space times a 10,000 square foot space gives you $250,000 divided by 12 months. Your rent is going to be just under $21,000 per month for this 10,000 square foot space. These types of prices are going to be like nicer office spaces, B class, maybe even A class in some cities. But you have different types of leases, okay? So these are more for office leases. Gross, modified gross. I know I'm jumping around here, but it's important. Gross and modified gross, it depends on the property type. This is mostly office and industrial. When it comes to bigger buildings, or when it comes to retail, like a Starbucks or a Burger King or, some random restaurant franchise, you're probably going to be looking more into triple net leases. But I'm getting ahead of myself. Let me explain these very quickly. So for a single net lease, the tenant is most likely going to be responsible for rent and taxes. A double net lease, the tenant is responsible for taxes and insurance. And then with a triple net lease, this is your most passive form of lease, if you are the landlord, is going to be triple net. The tenant is responsible for pretty much everything, and then obviously it also depends on what you negotiate in the lease itself. So let's talk about key commercial real estate metrics here. So number one is NOI. This is going to be your most important metric. This is basically your net operating income. It is your gross income minus your operating expenses. And don't worry, I'll go into depth in NOI in the next couple slides. But just know it's basically income minus expenses. It doesn't count your interest or your mortgage on the property. Think of this as your EBITDA, your earnings before interest, taxes, depreciation, amortization. Your capitalization rate, aka cap rate, this is going to be your net operating income, which we just talked about, divided by the market value of the property, or what you think the property is worth at the time. Then you have cash on cash return. This is basically your annual pre-tax cash flow, so how much money you're making before taxes divided by the total amount of money you have in the deal. And then finally, you have your internal rate of return if you want to play with the big boys. And all this stuff gets done in Excel, guys. The whole financial world runs in Excel, just so you know. So I can show you examples of that later. So IRR is your internal rate of return. This is basically estimating the amount of interest you'll earn on each dollar invested in a rental property over its holding period, okay? So it's almost like a very advanced version of like NOI and also cash on cash return. So in the next slide, I'm going to show you how to start calculating this stuff, but here's a quick word from today's sponsor, Fundrise. Real estate syndications can be a great way for individual investors to participate in larger commercial real estate deals and help outpace inflation, as mentioned in this video. If you don't want to vet sponsors but still want this exposure, I personally use a company called Fundrise, and I've invested my own money with them since 2019 and continue to do so. Fundrise is essentially a platform that allows you to invest in private real estate deals that you most likely wouldn't have had access to or enough capital to do so on your own. This is all done through your mobile device or desktop, and it's super simple to set up. The nice thing is that you don't have to be an accredited investor to use Fundrise. At the time of this recording, they have over 371,000 active investors, $6 billion of assets under management, and $223 million in net distributions earned by their clients to date. Since you don't have to be accredited, any U.S. citizen or permanent resident over the age of 18 can invest. Investments can be as little as $10 and all the way up to $100,000 or more. Their most popular tier, which is their core portfolio, starts with an initial investment of $5,000. Inflation, as you know, crushed the average saver's portfolio in 2022 with inflation rates higher than 7%. While the average savings account was earning a fraction of that. So real estate has historically kept up with inflation in the worst of markets, and other markets have blown past inflation in overall returns. Fundrise is the country's largest direct-to-investor alternative investments platform built to outperform today's volatile market conditions. Overall, I'm happy with my Fundrise portfolio, which is at 5.6% return year to date, compared to the S&P 500 being close to negative 20% year to date. If you're interested in adding real estate to your portfolio, check out the link in the description below and start the new year off by diversifying your portfolio with Fundrise. Okay, so how do you make money with commercial real estate? Let's talk about some of the metrics we use. So there are two biggest things that you're going to make money with in commercial real estate is your income, aka the cash flow that the property brings in or doesn't bring in. There's a lot of properties that don't cash flow or are underwater, but mostly a lot of people that aren't holding these things for generational wealth, they're most likely holding these for 2 to 10 years, most likely 3 to 5, and they're forcing the appreciation and cashing out with equity, okay? Either a cash out refi, which is tax-free, or they just sell the property, 1031 exchange it into another property, they forego their taxes for that transaction. But that's outside the scope of the slide. Let's talk about net operating income. So net operating income is your gross income minus your operating expenses. This is before your income, taxes, and interest, which I talked about in the previous slide. This is essentially your EBITDA, as I mentioned, your earnings before interest, taxes, depreciation, amortization. This is the best metric to assess the financial health of a property. So let's go through a quick example here. So in this example, we have revenue. So I just made these up, okay? So if it doesn't make sense, just think of this from a principle standpoint, okay? Don't get lost in the math, even though the math is very easy. So let's pretend the property brings in $100,000 in rental income. Let's just pretend this is a multifamily building, right? 10, 11 units, something like that. I'm just making this up. So say you're making 25 grand a year from parking. You're charging parking, and then you have laundry making you $5 grand. So the total gross income for the property for this year is $130,000. But then you also have expenses to maintain a property. Let's say you have $5 grand in management fees, 25 grand in property taxes, 15 grand in repairs and maintenance, $1,000 a year in insurance. I'm just making this up for a total of $46,000. So your NOI, for all the smart people in the audience, it's 130 grand minus 46 grand, which gives you an NOI of $84,000. Pretty simple, right? It is, and I'll show you why, because we're going to calculate a cap rate, and then I'll calculate the price of a building. So let's talk about cap rate. This is your capitalization rate. This is essentially your return on the investment, aka ROI. So this is a measure of profitability of a property relative to its cost, okay? So if a property made you $1 million a year and it cost $1, that's a ridiculous cap rate, right? But if it made you $1 million a year and cost $17 billion, that's not that great of a cap rate, right? So you have to make an apples-to-apples comparison. So investors use this to compare properties' returns. Lenders use this metric as well as others in order to see if you're credit-worthy or loan-worthy, right? Let me hammer this home. I should have hammered this home way earlier in the video. Commercial real estate does not gain its worth based on like a single family home. Oh, you have 3 bedrooms, 2 baths, and then 10 other properties around you have those same amenities. Okay, this is what your property's worth. 200 grand, right? No, commercial real estate, it's derived from its income, for its ability to produce an income stream, for its net operating income. That is how these properties make money. So I can have a 1-bedroom. That's a bad example. I can have a 5,000 square foot office space, and if someone's paying me $10 million a month in rent, that property is going to be a ridiculous amount of money because the NOI is going to be very high. That's just an outlandish example just to understand where I'm coming from. But let me give you a quick real-life example. So to calculate cap rate, you take your NOI, which we figured out in the last slide, which was $84,000. You divide it by the market value of the property, or what the property is being sold for. Let's just pretend that the the property cost is $1.4 million for our building with an $84,000 NOI. Your cap rate is going to be 6%. Now, you can also do this in reverse, okay? This is middle school math. So if you take your NOI divided by your cap rate, so if I took $84,000 divided by 0.06, aka 6%, you'll know what is a fair price for the property because of its income stream. Make sense? Okay, glad that made sense. Now let's continue. So how do you make money with commercial real estate? Well, here's one of the biggest ways. It's value add, okay? It's adding value. It's forcing the appreciation of the property. You can only fix up a single family home so much. It's still going to be worth relative to what the other houses around it are worth. Remember, you buy the cheapest house in the nicest neighborhood, okay? That's how you make the most money. But with commercial real estate, again, it goes back to its income stream, its net operating income. So what is a value add to start with? So I try to give a quick example here. You kind of have a before and after picture. You have, laminate, dishwasher, floors, paint, whatever. Fix it up. Hey, I can now raise the rents, right? So investors buy this to make light to significant property upgrades. So what kind of upgrades are we talking about? Well, there's a million, but generally you have physical, which could be landscaping. It could be improving the units like multifamily, similar to this picture right here. You can have operational upgrades such as cutting costs, changing management, billing tenants differently, when it comes to like utilities, raising the rents, things like that. But mostly it's a combination of both. It's just making a business more efficient and a better value for your renters, okay, your tenants. So what are some goals of adding value? Why do people take on these deals? So these are typically, distressed properties. It could be a C-class property in a B-class neighborhood that can be raised to the level of a B-class property with some changes, right? And then you can command higher rents, increase the NOI, which I'll show you in the next slide. So your goals are typically to increase rent, increase your income, decrease vacancy, okay, improve management, maybe being more efficient, and then increasing your NOI, aka forcing that appreciation, which we talked about. So moving on, let's give a quick example. Let's pretend that property that we just talked about in the last two slides is an 11-unit building. Okay, I'm just making this up. So we already went over these numbers. Let's pretend our 11-unit throws off is worth $1.4 million. It throws off $84,000 a year before the mortgage, and the cap rate for the neighborhood or the cap rate for that area for this product type is 6%, right? But now we're going to do a value add, okay? We're the nice... We're the real estate developer that knows how to raise the rents by, let's just say, $100 per month per unit because we know how to improve it for what that marketplace wants, okay? Say, for example, people want granite countertops or, nicer amenities or, a doggy park or a pool or whatever, a gym. All these things can be used to increase the rents, okay? So I'm just using $100 per month. Typically, if you're a developer and you're actually doing one of these deals, you want to shoot for a lot more than this, typically in the $300 to $500 per month range per unit. But I'm just using 100 for easy numbers. So not only did we raise the rents, but we also fired the old mom and pop running the place that were super inefficient, and we hired a nice management team, but it ends up reducing our operating costs by $250 a month by how efficient they are. So if we take $100 per month, raising the rents by 11 units times 12 months, we just created an additional $13,200 in additional revenue per year. Now, we also reduced our annual expenses by $3,000 because we're now saving $250 a month times 12 months, which is $3,000, okay? So now our income used to be $130,000. We're adding $13,200, which gives us a new income of $143,200. Our expenses used to be $46,000 a year. We reduced them by $3,000 a year, $250 a month times 12, and now we have $43,000 in expenses, which for all the math wizards who graduated elementary school, sorry, that's kind of mean. It's basically simple math, you guys. Our NOI is $100,200. We know that these types of properties with these types of amenities go for a 6% cap rate. So our $100,200 divided by 0.06, our cap rate, now gives us a property value of $1.67 million. So this property, before all these improvements, used to be worth 1.4. Now it's worth over $250,000 more just by getting new management in place and also by raising the rents by $100 a month on 11 units. So that's just an example I came up with just for the sake of simplicity. But on huge deals where you have hundreds of units and you're raising them $300, $400, $500 a unit, and you're really dialing these things in over the period of 3 to 5 years, where you're getting old tenants out, getting new tenants in at a higher price point, you can really reposition these properties to make literally millions of dollars. Okay, so moving on with my thoughts. So as always, I could have got into way more metrics. I could have got into way more examples, especially real life examples. But just to keep this video, not ridiculously long, I'll just give you my thoughts at the end here. So commercial real estate is very powerful, but you're also competing against people that do this for a living. This is not your hobbyist, guy working an 8 to 5 job, 40 hours a week. He's got a rental property on the side. This is not that game. This is literally big boys and big girls that insurance companies, huge insurance companies buy these deals, Wall Street, REITs, all that stuff, right? So anyway, my point is that it's a highly financialized product and you need to get good financing. Financing is different on commercial real estate than it is with residential. You typically have smaller loan to values, and then you also have balloon payments. You have different amortization schedules. I can make a separate video on that. It's not good enough for, or it's too in-depth for a quick snippet in the my thoughts portion of this video is what I'm trying to say. So not only that, you're playing with the big boys and big girls, but the nice thing is if you really find a coupon clipper, the developer that I worked for, like I said, we had over 1 million square feet of office, residential, or multifamily, excuse me, and then industrial. So 1 million square feet of office and industrial, 300 units of Class A multifamily in a college town. So basically, I was part of all those deals from the ground up to disposition to acquisition. I can tell you this: if you have a nose for a deal and if you know how to lease these things up, if you're seeing 15, 20, 30% vacancy, you're a, I don't want to say schmoozer, but you work with good brokers and you're highly networked in the area, you can get a lot of tenants to these buildings, increase the NOI, sell the thing in 5 years, and you can actually go through what's called a 1031 exchange. So when you have a capital gains on a house, let's just say you have a house for $100,000, you sell it for $200,000, you have capital gains of $100,000, you can 1031 that. You can also do that with commercial real estate as well. So if I have a building that cost me $1 million, I increase the NOI so much with good tenants that I get the value of $4 to $5 million. I can defer that with a 1031 exchange by buying a like or similar property within a certain time frame, and I can forego the capital gains of $4 million in this example, okay? And what sophisticated investors do is they keep 1031ing, they defer all the way until they die, and then their heirs or their inheritance, they get that property at that step-up basis level. So instead of paying taxes or the capital gains all throughout those years, like the $4 million that I just talked about, they would get the property stepped up at that $5 million tax basis, and that way, they're starting at 0 as opposed to $4 million of taxable income when they inherit the property. This is what rich people do, okay? That was a very long-winded way of saying rich people invest in commercial real estate, but you can also get burned as well. It just increases the stakes by that much more. So I hope you learned something from this video. If you want to go deeper, maybe I'll create like a commercial real estate analysis course. This is what I used to do for a living. I literally lived in Microsoft Excel. So I've been rambling way too much. Thanks for Fundrise for sponsoring the video. Thanks for sitting through these sponsored videos. They help me pay the bills, and I don't charge you a dime for any of this stuff. I've been on YouTube for 5 years, haven't charged you for a single penny of anything, and I hope I've given you a lot of knowledge for free. Thank you so much. Share the video. Have a prosperous day.